Good afternoon. It's the decision of the Reserve Bank of King's College to maintain the official cash rate at 3.5%, with the primary view of keeping inflation within 1 to 3% over the medium term, as outlined by the Policy Targets Agreement. In the first quarter of this year, CPI inflation stood at 0.1%, outside of the target band. However, considering the temporary supply-side nature of this low inflation, as well as the numerous inflationary factors and high projected growth expected in the economy in the next year, we believe that the current OCR will be sufficient in providing the stimulus needed to boost growth and inflation. We shall be considering a number of factors affecting the New Zealand economy and analysing the inflationary or deflationary impact. So first, we'll have a look at the inflationary factors. Capacity utilisation has increased from 89.4 to 92.3 in the past year, and is forecast to increase to 93.59 in the second quarter. A continuation of this trend will add inflationary pressures if demand pressures are also high. This is because as spare capacity decreases, the economy is likely to move further up the steep part of the AS curve, reducing the output gap. Sustained demand would mean that there are more buyers and more money buying fewer goods, and thus inflationary pressures would increase. As for inflationary expectations, 1 year out expectations remain low at around 1.32%. This is a slight increase from the historically low levels of the March quarter, and shows that while short-term inflation may remain low, there are expectations that this will improve. Also, the 2 year ahead expectations lifted from 1.8% to 1.9% as a result of the slight rise in petrol prices, and this is comfortably within the target band, showing that these low expectations won't be long-term. So, this reasonable long-term inflationary expectation indicates that at the current rate, we are on track to reaching the 2% goal. As for construction, there has been a short-term increase in activity in Christchurch from $2 to $5 billion, and a projected long-term rise in Auckland from $8 to $12 billion, causing inflationary pressure. However, this pressure may not be incredibly strong, as construction supply is relatively elastic due to the ease of bringing in new labour and raw materials, notably from migration into New Zealand. This migration is keeping wages within the construction sector contained. In terms of housing, Auckland and Christchurch have been huge drivers of house price inflation. Auckland has been underbuilding for a number of years, and this graph shows the growing gap between Auckland house sales and the monthly consents issued. Christchurch is also gaining momentum from the earthquake rebuild, with building activity set to peak in the coming years. This graph shows how net migration is continuing to fuel demand for housing, and is forecast to keep growing in the next 9 months, all inflationary. As mentioned, there has been a growing inflow of migration since 2013, with net migration reaching decade-high levels this year. This graph shows the upward trend of net migration. These strong levels of net migration are primarily caused by the New Zealand employment prospects, especially in comparison to Australia. This graph reflects how New Zealand's 5.8 unemployment rate has appealed to Australians, and it also shows that how net migration is the strongest it has been from Australia since before January 1996. The 4 components of aggregate demand are consumer expenditure, investment, government expenditure, and net exports, and net migration helps boost 2 of these, C and I, as migrants bring in wealth, spending money, pressure on infrastructure, and demand into the economy. This increase in AD is likely to lead to inflationary pressure as capacity becomes constrained. Now we should look at the deflationary factors. Business confidence has fallen recently. Headline business confidence fell 15 points in May to 15.7 points, and a net 16% of businesses are optimistic about the economy, compared to a net 30% in April. Also, pricing intentions dropped from 28.3 in March to 22.6 in May, its second decrease in a row. Firms' own activity expectations, generally seen as a good growth indicator, eased to a 2-year low of positive 33 points. This is still quite high, but it is certainly dropping. All of these factors indicate a general decrease in confidence in activity levels, which are all deflationary. Oil prices have fallen about 50% below its June 2014 peak due to oversupply and weaker demand. Most businesses have oil-related costs, and so this reduction of cost pressures could increase aggregate supply, as now businesses can produce more for a lower price. This, combined with an increase in households' purchasing power, means that deflationary pressures are likely. However, while it is clear that oil is deflationary right now, its influence on our OCR decision depends on its recovery, which this graph shows has hugely varying predictions. The New Zealand dollar was strong in April, reaching a rate of 99.26 to the Australian dollar, and at a rate of 0.7132 to the euro in April. The New Zealand Trade-Weighted Index reached 80.08 in April 2015, up from 78.27 in January. However, since then, the New Zealand dollar has dropped by 4.5% on a trade-weighted basis. It is uncertain whether this will persist, as a key driving factor is an expectation of an OCR fall. As it remains relatively high, and is likely to be influenced by continuing programs of quantitative easing in the EU and Japan, we have considered the exchange rate as a weak deflationary pressure. As for the dairy industry, global dairy prices have fallen around 50% over the past year. As a consequence, farmers now stand to earn around $6 billion less than in the prior season. In the recent Frontier Global Dairy Trade Auction, dairy prices reached a 5-year low, falling 3.2% in its fourth consecutive decline. This decline is due to an oversupply of dairy produce and a fall in demand from the Chinese economy. Prices are expected to remain low over the next few months before they start increasing as supply and demand come back into balance due to an increase in global demand. This fall in income, which represents a fall in demand, is deflationary. The dairy industry has been flagged by the Reserve Bank as one of the key risks to the New Zealand economy, as stated in its November Financial Instability Report. It said that the high levels of indebtedness in the dairy sector, as well as potential effects of a slowdown in the Chinese economy, were two huge factors, and we have similarly considered them as important deflationary factors. It also mentioned the banking system's reliance on offshore funding, and if dairy farms struggle, the economy will contract, with the higher risks causing New Zealand's credit ratings from offshore banks to decrease. This will in turn create higher interest rates and higher costs for consumers, a flow-on deflationary effect. There are also a few other factors that we considered. The world outlook has factors which are both inflationary and deflationary. In China, GDP growth is forecast to drop from 7.4% in 2014 to 6.9% in 2017. This slowdown has resulted in export prices from New Zealand to China falling, creating deflationary pressure. But in the US, an unemployment rate of 5.5% has prompted suggestions of a rise in interest rates, which could lead to a depreciation of the New Zealand dollar and thus create inflationary pressure. However, there's uncertainty as to when this will occur. The Reserve Bank of Australia, although having cut interest rates in May, has left it unchanged at 2.0% in its June monetary policy decision. Overall, the global economy continues to recover slowly, which could signal inflationary pressures in the future. In terms of wage inflation, the annual wage inflation of the Labour Cost Index rose 1.7% compared with annual consumer price inflation of 1.6%. This wage inflation is in line with the CPI and is relatively soft due to a number of reasons. The unemployment rate increased from 5.4% to 5.7% in the fourth quarter last year, part-time work has risen, there has been an increase in the underemployed where more hours could be worked, there have been looser contracts which help create more flexible workforces, and in general, workers' bargaining power has dropped. Thus, there has not been much added inflationary pressure, but no deflationary pressure either. The current low inflation begs the question, are our estimates of the neutral rate too high? The neutral rate in New Zealand is estimated to be between 4.5% and 5%. On this premise, 3.5% is a sufficiently stimulatory rate to target the low inflation. However, there has been some discussion on whether the neutral rate is actually lower than this, which may mean that the current rate is more contractionary than expected. The explanations for this could be that there is a high propensity to save, high capacity, and a weak inflation backdrop around the world. However, until this is more firmly established, we believe it is appropriate to consider the current rate as stimulatory and thus retain it. So in conclusion, we've decided to keep the OCR at 3.5%. Lowering the OCR would be unwise considering the inflationary pressures we have mentioned, but raising the OCR would be unwise also, considering the low current state of inflation along with all these deflationary pressures. If inflationary expectations hold, domestic activity and confidence levels begin to catch up, and the significant deflationary pressures, including oil prices, remain short-term, we would expect inflation to pick up by the end of 2015 and return to 2% in around 2 years' time. If we look at the split of inflation into its tradable and non-tradable components, we see that tradables take up around 43.6% of the CPI and non-tradables take up 56.4%. We think that the 2% inflation we see in the non-tradable sectors indicates the positive outlook domestically, and the negative 2% tradables inflation reflects the lower world prices currently. However, since non-tradables take up a bigger part of the CPI, we think that it is currently justified to keep the OCR at 3.5%. Thank you.
Thank you very much. Lots of information there. I did notice that you kept the official cash rate constant. However, the Reserve Bank did actually lower it in June. Can you explain what the consequences of lowering the official cash rate will be on the New Zealand economy?
So firstly, lowering the interest rate would encourage more borrowing, so more investment, and that would boost aggregate demand. Yeah.
On the consumption side, you also got like house current mortgage rates. If you lower the interest rate, you get, floating mortgages. They you have decreased your payments, and so I guess consumers would think they have more money to spend. Therefore, you'd probably raise your consumer expenditure.
Lowering the interest rates, you'd get less hot money.
Yeah.
Less attractive for
Good effect on the exchange rate.
Yeah. So that's probably contributed to the decrease in our exchange rate that we've seen.
Yep.
I guess you could talk about the science behind it. If you decrease the interest rates, you increase the money supply,
Mm-hmm.
and then you get the increase in money supply. Assuming demand stays constant, you'd get an increase in the amount of money that people actually want to borrow.
Yeah. So banks have more to lend, so they'd probably be perhaps less stringent with lending it, and so it'd be easier to borrow, and that would mean that it's more profitable for firms to invest in things like capital, which would allow them to produce more, and that would fuel the inflation in the economy, which is what the aim is.
increase economic growth.
Yeah.
Another point you could probably add is if depending on like the output gap, or depending on how much spare capacity you have in the economy, a decrease in interest rate. If it depends, if you have a very small output gap and you have not much spare capacity, it's probably going to be more inflationary.
Yeah.
Whereas you have like developing countries, New Zealand's not exactly developing; it's already developed. But if in New Zealand currently the output gap's small,
Yeah.
So you're probably going to have inflationary pressures. Whereas if there was a larger output gap and there's larger spare capacity in New Zealand, you'd probably get more of an actual increase in production
as opposed to
inflationary pressures.
Mm-hmm.
Okay. So do you want us to wrap that up? Or?
Please. Yep.
Okay, so we think that overall there are quite a few effects on the New Zealand economy. Firstly, we think that because interest rates are lower, that means it's easier for consumers to borrow money. Because of this, they have more to spend, and because of this, this can help fuel retail sales and thus boost the economy and possibly raise inflation because of the increased aggregate demand. We also have the mortgage rates which are lowered, and because of this, again, disposable income will be increased, but with a similar effect. There will also be less hot money coming into the economy because of investors from overseas, and because of this would actually lower our exchange rate, which could also have an impact on increasing import prices, which would also increase imported inflation. It would also increase the money supply, which could make banks lend more money and more willing to lend, which would make it easier to borrow and more easy for firms to gain capital, produce more, and create more activity in the economy. And finally, it would also increase growth. But the effect on this on inflation rates would depend on our overall capacity, which we think currently is quite close to full capacity. So we think that an increase in growth would lead to an increase in demand for restricted amounts of materials and capital, and so there would be an inflationary effect.
Cool, yeah, that's a great answer, guys. Well done. One of the things that you noted in your presentation was that the rate of inflation is currently quite low. I think you had 0.1 at the time of the June statement. It's ticked up to 0.3% annual now. Is it bad that the rate of inflation is this low?
Well, the problem you have is, you can start off with is that the problem behind it would be being so close to a zero inflation or negative inflation. Once that happens, you start getting paradox of thrift and where deflation spirals down. But
So the problem with deflation is that it's actually incredibly hard to get out of. So if we're at 0.3, aside from there being not much growth in the economy, if we hit the zero or negative, you get low inflationary expectations, so you get paradox of thrift, and then it's really difficult to stimulate the economy, so you get into a liquidity trap, which you see in places like Japan at the moment, and America trying to get out of that, which is incredibly difficult.
Yeah.
you also, once you get into the liquidity trap, the only really option for monetary policy, fiscal, there's a lot more options because you've just got government spending, but monetary, quantitative easing is probably one of the solutions to that problem, and also, I guess, low inflation. It depends on the, it depends on the tradables and non-tradables. Currently, with low inflation, it's largely because the tradables are low, whereas non-tradables, the domestic products, are still high. But the problem is, once you establish a rate of inflation, the mindset of people tend to be to prepare for that rate of inflation and therefore to price for that inflation.
Yeah.
So you automatically get the shift towards that inflation.
So it does depend on whether that current rate of inflation is stable. So if it's stable and people expect it to be around 0.5, for example, then it actually wouldn't be too bad. But as long as it stayed around there and didn't keep going down or keep going up exponentially.
Yeah. Okay, so we think that overall there would be a decrease in inflationary expectations because, if the inflation rate was dropping, then we'd expect there to be lower inflationary expectations, and because of this, it would be much more harder for the banks to create a change around these expectations, because if there is deflation, or if there begins to have deflation, then there'll be things such as the paradox of thrift, and because of this, there'll be a liquidity trap in which monetary policy becomes much less stimulatory, and you have to have other methods such as quantitative easing in order to stimulate the economy.
Sure, good answer, guys. So in your answer there, you mentioned quantitative easing. So I suppose I've got a couple of questions. If you were in a situation where inflation is still very low, but the official cash rate is at zero, what could the Reserve Bank do about it? One of the things you've mentioned is quantitative easing. So as part of your answer, you might want to elaborate on what quantitative easing is and how that might work.
So essentially, it's like where the central bank injects money into the economy by buying, for example, like you buy the bonds of the governments or other companies, and therefore increasing the supply from the banks to lend out. And the effect this has is, increase the money supply, banks lend more.
Also, we've got the danger of like hyperinflation with quantitative easing, printing money.
Yeah. The bank could also possibly make some statements, like for example, if they say that we expect we are going to introduce this quantitative easing method and we're going to want to stimulate the economy, then this could possibly create a change in consumers' or businesses' expectations. I think that if the bank's going to be stimulated, then therefore the inflation is going to start stopping. This could possibly create a reversal in expectations, which could fuel.
There's also this doesn't happen in New Zealand as much, but there is the possibility for exchange rate manipulation. So we know China's just devalued its exchange rate in order to make the exports, the prices cheaper, so that boosts the exports, which would fuel the demand in the economy, and that would allow you to have growth. And although that doesn't happen in New Zealand,
it's still an option.
It's still an option. Yeah.
And I mean that they could also again make statements about it, as we saw at the start of this year. The bank was talking about how the exchange rate was definitely overvalued and it had to drop sometime or later. And so through this they can also create a mentality in the market for the exchange rate to drop, and which we've seen has happened before, happen now.
I think an important part as well, as Martin mentioned before, was about mindsets of consumers and businesses. You know, if you can put it into the minds of business and consumers that they need to spend and they want to spend, you're going to stimulate inflation. And then the options you meant by statements from the Reserve Bank of needing, as long as you can change the mindset of the consumers, then you'll start getting inflation.
Yeah. So overall, we have around three different main methods which the Reserve Bank could use. Firstly was quantitative easing, which the Reserve Bank injects money into the economy by buying bonds, and through this you're increasing the supply of money, and through this you're creating more money in circulation, thus increasing the amount of money chasing the goods and therefore increasing inflation. Secondly, there would be making statements, whether it be about the exchange rate or about simply the need to stimulate demand, and through this you can change inflationary expectations, you can change the mentality of some consumers, and this can possibly turn around some spending patterns. And finally, the exchange rate manipulation, in the sense of if we devalue the currency, whether it be by free market cause or by actually doing it using reserves of foreign currency, which New Zealand doesn't do, but it's an option, then that could also increase import prices, reduce exports, and through this stimulate demand and increase import prices.
Very good, thank you. Let's change topics slightly. We've seen a dramatic drop in oil prices and also a dramatic drop in dairy prices. Can you explain the impact on the New Zealand economy of those two changes, and particularly what the different channels that those two prices might work through?
Okay, so I guess for oil, it's mainly an import for us because we don't produce oil. So, and it's also it's also we don't produce much.
Oil.
Yeah. But it's also it's a very widely used commodity, I guess. So because of this, if you have a lower price, then many businesses will have cheaper operating costs, and because of this, you'd actually get an increase in aggregate supply, which could help increase some of this capacity and therefore reduce the amount of inflationary pressure.
You can also talk about the impact on the New Zealand dollar.
Okay,
How import and export prices. If oil prices are dropping.
Oh yeah.
I guess another thing is with dairy, you got to decide whether the drop in dairy prices has been because of an increase in supply or a decrease in demand.
I'd say it's both.
Yeah, as we've
Yeah,
seen in
both,
the presentation, it's both currently.
Yeah.
And so, assuming that both are roughly equal, you're probably not going to have a change in the quantity of the goods trade. Just the or you might. I'm not sure of the elasticities of the demand, but either way you're gonna have a decrease in price with. But that quantity could go either way depending on the strengths of changes in supply and demand.
But in
So
terms
you
of
look
the
at-
in terms of the impact on the New Zealand economy, because I think that was the question.
It really depends on the elasticity of like things like dairy prices. So we know that in the past they've been incredibly inelastic. So despite the high exchange rate, we've been able to sell a lot of them. But as the supply increases globally, like China is increasing supply in the EU and America, it becomes more elastic, and so that has more of a damaging effect on our economy. So it's particularly has an impact on the rural areas. So the revenue for the farmers goes down significantly, and because of their indebtedness, because a lot of them, their asset value is in the farm, and so they borrow a lot based on that leverage. And when they're not getting enough revenue, that becomes really problematic for them to try and pay it back. So it could increase the sort of disparity between the rural areas and places like Auckland.
And I guess just on the basic level, if farmers have more debt, then it's much harder for them to spend on things such as new tractors or new equipment, and
Yeah.
because of this could reduce the amount of revenue or activity in these rural areas, which could have deflationary effects on the economy as a whole, because dairy is such a big part of our economy.
Another thing on I think we forgot to mention on the oil side, if you have a rise in import in oil prices, that's a cost of production.
Yeah.
And if you're going to have a rise in cost of production, that's a decrease in supply, and
Yeah.
you could get cost push
Yeah.
inflation, and which is
But that was the question was a decrease in oil
Yeah.
price.
oh
Yeah.
oh,
the
it is.
decrease.
Oh,
Yeah.
whoops, sorry.
You've,
Okay, yeah.
you've also
That's
got to look
increasing.
at the impact of like falling dairy prices.
Yeah.
It depends on, because actually a lot of the fall in prices being the milk solids, but the other factors that we're selling in dairy are actually, and like in that industry, actually, they're still relatively high priced. So the impact of that depends on what percentage it takes up of the dairy industry.
Okay, so we think in terms of the drop in oil price, we think that because oil is a main import and a very commonly used raw material for many businesses, that if a decrease in oil price happens, then it would cause many producers to be able to produce more, therefore increasing aggregate supply and creating a deflationary pressure. In terms of the drop in dairy price, we think that it can depend on the elasticity, because currently, before the dairy market was quite inelastic, but because there's new supplies coming onto the market from places such as China and Europe, it's become more elastic, and so any drop in dairy price can have a much more adverse effect on New Zealand dairy farmers. And we provide examples such as these farmers running into debt and having to take many months to recover from this debt, and because of the spending less on things such as equipment and through buying in these rural areas, and this can cause a strong deflationary effect in terms of these rural towns where these farmers are.
A great answer, guys. One thing that you might have seen since the June monetary policy statement is that the New Zealand dollar has dropped a lot, really since, I guess, April this year. What do you think has driven the New Zealand dollar down? And then I guess as a follow-up, what impact will the lower dollar have on the New Zealand economy, and how should the Reserve Bank respond to that impact?
I guess the most significant reason the dollar's been driven down is the lower dairy prices. So those were propping up our dollar because of the demand for it, but as the prices went down, there's less demand for the New Zealand currency.
I think another point to add is also, I remember, was it when we've had the first presentation, the prices of oil had dropped dramatically. It was like $1 a litre for diesel, but now they've seemed to jump back up again, and the rise in oil prices again, a rise in import costs, and now devalued, and because oil is quite it's quite an elastic cost production, you're going to get as you have to pay more for it, your exchange rate's therefore going to depreciate as well.
And also the impact would be that our exports would be more competitive in the international market, so in terms of dairy prices. And we'd also have imports more expensive, which brings imported inflation into the economy.
Also, another reason for the devaluation of the exchange rate has been the growth in the other currencies around the world. So in the US, their economy has been slowly growing, and because there's been talk of a rise in their rates and the strength of their dollar, that's pushed ours down in comparison to theirs, and the European economy are going quite well as well. So because those economies have improved in comparison, that could contribute to the devaluation of our dollar.
Yeah, that's the sorry, just a point. I'm not sure. It's
Yeah.
good, not with it. When the other economies weren't, after the GFC hit, weren't going so well, the New Zealand exchange rate, OCR, was quite high relative to other countries. We're probably having quite a bit of money stored in New Zealand as, I guess, hot money, or just because interest rates were a lot higher here, you get a bit higher return. But as other countries, they start to build up their interest rates, money goes back into the other countries, and New Zealand.
Also, you could look at the fact that the Reserve Bank and other, banks thought that it was overvalued. So perhaps this is just a necessary correction of an overvalued exchange rate.
And how would the Reserve Bank respond to this? That's part of the question as well. In terms of the lower New Zealand dollar.
You mean how would it affect?
How the Reserve Bank would respond, I believe the question was.
Yeah, so how's that going to affect the New Zealand economy, and what's the best response of the Reserve Bank to that effect?
So
I think because inflation is so low currently that a drop in the New Zealand dollar will be quite beneficial for us because of, as we said before, an increase in imports and drop in.
again, it does
export
depend on
prices.
the elasticity.
Yeah.
So because imports tend to be more inelastic because of the contracts that we have in terms of we need them more at the moment.
Yeah.
So that could be an inflationary pressure.
I mean, there'll also be a bit of a time lag, wouldn't there, because
Yeah,
of like the
true.
pipeline and Jacob effect. So there'll be a bit of a time lag.
And also, if you have if you're having an increase in slowly increasing oil prices because of a higher exchange rate or a lower exchange rate, you're going to have increased cost of production, but at the same time you can have an increase in exports. You're going to get quite a bit of inflation pressures.
Yeah.
So it could be in the best interest of the bank, excuse the pun, to I guess increase the exchange OCR. That is, if there are inflationary pressures present at the moment.
Yeah.
It's a slow decrease.
Yeah. So I think there are a number of factors. Sorry.
In terms of what the Reserve Bank could do about it, in terms of
Yeah.
So the question is whether they want to do anything about it, because I think it's actually quite a positive thing for the
I think
economy.
beneficial,
So there's no way that they could artificially prop it up without, injecting.
Yeah.
So
So I think in terms of what's driven this drop in New Zealand dollar, we think that because it originally was quite overvalued, as the bank stated, that this could just be a natural sort of readjustment of its value. Because of the rise in other rates of the interest rates of other countries, there could be some hot money moving out of the country, which could again increase the supply, reduce the price of the New Zealand dollar. Because of the growth of other currencies, such as in the US dollar and the potential rise of rates there has been again growth of other currencies, and because of this a relative devaluation on our side, and because of the lower dairy prices, there's been less demand for these dairy products, less demand for our currency. And finally, also the slight rise in oil prices, since they're very low at their trough during March or April. This could also drive down the New Zealand dollar. In terms of its impact, so it would make our exports more competitive because it'd be cheaper. It also make our imports more expensive as well, especially because considering the inelastic nature of them, such as oil. And this would, but the overall impact would depend on the elasticity of these two things, and also depending on the time lag, there may be like a 6 to 12 month time lag between the drop and the actual impact we see in the economy. And in terms of how the Reserve Bank would respond, we think that it's currently quite beneficial because of our low inflation rate, and because of this, we think that it wouldn't be necessary for the Reserve Bank to do much about this currently.
Very good, thank you very much. We have time for just a couple of questions. So you mentioned in your presentation neutral interest rates. Can you give me a definition of neutral interest rates?
It's just one that isn't contractionary nor expansionary. So one which doesn't stimulate the economy, but that also doesn't cause
Deflationary
contraction in the
threats.
economy.
I believe it's about 4.5 to 5%
Yeah.
in New Zealand.
So you just need to state that.
Oh, well, we think that it's around 4.5 to 5%, and it's just when the rate doesn't have an expansionary impact or a contractionary impact on the economy. So it wouldn't actually stimulate any increase in demand, but it wouldn't cause any demand to decrease anyway. It's sort of like the natural sort of demand, like it causes the natural growth of the economy.
Okay, we're out of time. Thank you very much. You can now relax. We're done.